Welcome to another episode of Box Seat. Box Seat is a podcast featuring some of the best consumer brands from Britain. We're looking to give up to £1 million in funding to the future consumer brands of tomorrow. Brands that not only want to be profitable, but make a better world. I'm very proud to be joined by Kevin Shone, partner at Artorius Wealth Management. I've known Kevin now for about 3 or 4 years, haven't I? Yeah. So, Kevin, why don't you just start by telling us, give us an intro to yourself in terms of what you do at Artorius and maybe about the beginning of your career and how you got started out.
Okay, pretty basically, I'm a lad from Wigan, from the northwest originally. Came down to London many years ago now, back in 1987. Before podcast didn't even exist. Most of the staff in my office didn't exist by that point, as you can imagine.
No internet?
No internet, yeah. Very embryonic. Yeah. Embryonic computing at university and things.
No working from home?
No working from home, absolutely not. Yeah. Just embryonic emails even, just initially. But that was 87, spent about 12 years in London, joined Coutts on the graduate programme.
You became managing director?
A managing director.
Right.
Managing director levels at
okay. How many managing directors are there?
There were different stratas at that point. They didn't even call them managing directors at Coutts at that time. They were
right.
Senior client partners, principal client partners, had all sorts of different titles.
Wow.
But as senior as you could get in terms of client-facing roles. And then went to Goldman Sachs.
Where you were managing director? I
was a managing director at Goldman Sachs here, but these are all bank titles, not what you would describe as a CEO. These are sort of managing director level titles. So the most senior kind of you can get at that level of the bank.
And how long were you at Goldman for?
3 years.
And you were at Coutts for a long while, weren't you?
17 years at Coutts.
Wow.
Yeah. Went through a big change at Coutts when I joined. It was still owned by NatWest and was very private banking orientated. And then the sort of RBS initiative came in with that merger purchase of NatWest. And it did change quite a lot over those 17 years.
And when you were at Goldman Sachs, what were you doing? Was it the same sort of thing?
Same sort of thing, yeah. Same sort of diet, working in the private wealth division. Joined in 2008. Beginning of which was a wonderful time to join a global investment bank, as you can imagine, just as they all started falling over. Yeah. But yeah, 3 extremely interesting years at Goldman's. But very different proposition because I went there to do more of a wealth management role, to broaden out the horizons of what they did. But you can imagine in 2008 trying to get a bank to change, and they ran away from lending and other things at that point, understandably. So it was a very different proposition I ended up with than I actually went there to do, which was
still
just
to be there for 3 years from 2008 when there was so much volatility. And then after Goldman, where did you go to?
Then I was at Barclays running the grandly titled ultra high net worth operations outside of London.
What's an ultra high net worth?
Ultra high net worth then in Barclays' definition, then going back a while, was about 50 million.
Okay.
Or that sort of level and above.
Don't make it.
So it was an interesting role, but on Flybe and a different plane every day to Glasgow, Edinburgh, Belfast, Bristol, wherever I needed to be. So a lot of travelling, different cities all the time. But again, an interesting role.
And then how did Artorius sort of come about? You know, and so tell us a bit about your role at Artorius. Were you one of the founding partners?
Yeah, one of the founders. I was in a few months later than the original guys, just because I was 6 months gardening leave. From Barclays at that time, so I had to sit out my gardening leave before I started.
Was Ian there beforehand?
No, Ian Marsh wasn't there at that point.
Yeah.
Richard Algar was the core founder, who sadly passed away only sort of 1.5, 2 years into when we set the business up. Very sudden, very sad. But yeah, I mean, Artorius was set up by effectively a bunch of guys from larger banks and backgrounds like myself, from likes of Credit Suisse and Deutsche Bank and I know Barclays, etc., where we all felt we didn't want to work inside banks anymore, and had reached that point of, I know, the conflicts of interest were just off the charts in terms of trying to service your clients. And our clients telling us, the bigger families, that they wanted a more sort of unconflicted, impartial service. And again, I suppose, I know financial services is expected to be very complicated, but the reality of it is quite an easy industry to understand. You know, if keep an easy parlance in terms of a car analogy, if you walked into a BMW dealership, the last thing you'd expect a salesman to say to you is, actually, you should buy an Audi or a Mercedes. It's not going to happen, is it?
Yeah.
And yet people will go to Barclays, HSBC, Goldman's, whoever, and expect they're going to get impartial advice.
Yeah.
Those institutions are set up to sell the product, and that's what they will do. So Artorius was set up to be an organisation that sits in between our clients and the wider financial world.
To give independent
advice and be impartial. So we are in the parlance of the industry more buy side than sell side. So I know in a property example, we're the buying agent acting for the buyer rather than the selling agent acting for the for the selling property owner.
Because I know when our paths sort of first crossed, it's when I started to sort of make some money, I guess. And traditionally I'd worked with other sort of private banks, and it can be quite limiting working with some of those private banks, because they might, for instance, say to you, look, we don't do anything in the private capital markets. And for those viewers out there that don't know what I mean by private capital markets, that might be private equity, that might be VCTs, that might be EIS investments, investing into private companies effectively. So that's a large tranche of the financial sector that they might go, look, we don't do that. And many of them still don't do that. But with Artorius, what attracted me to you was actually you've got a much broader remit. It's not just public markets, it's private markets, it's everything. So just tell us a bit about Artorius, what makes it a bit different.
Oh, well, I think the main thing where we try and be different is to be that unconflicted counterparty. So the clients come to us with the financial objectives from a range of different things, and they want an unbiased answer. Somebody sitting in front of them and say, well, actually, this is the way to meet your objectives. And the client knowing, I'm not trying to sell them anything. We don't have product. So we are selling our intellectual property and our best advice. And we're effectively that outsourced family office for a client. A client who thinks, well, I need someone advising me. I don't know whether the best answers are at Barclays, HSBC, JP Morgan, Goldman's. I don't know. I haven't got the skills to tell all the different products apart. And neither have I got the time or the appetite to go and find out either. Whereas that's what Artorius does. And for a lot of these clients, they don't need somebody 40 hours a week. So why hire somebody specifically to do that? And Artorius can do it because they might want us 2 hours one week, they might want us 8 hours the next week, but they don't need us permanently. So you can share that cost load. So it's far more cost effective, and you get the spread of knowledge. I mean, there are 50 people in Artorius now. We manage and advise on around about 2 billion of assets. So we've got that scale and expertise to be able to give the clients a huge breadth of advice, say, without the conflicts. I mean, you mentioned private capital markets, I suppose, are the classic example. Whether it's private equity, private credit, infrastructure, potentially real estate, as they call private markets, if you invest in those as a private client, those can be very, very expensive at a fee level. And again, if the person who's sitting in front of you makes maybe 0.25% on a fixed income mandate, and he makes 2% on a private equity mandate, 10 times the margin, which one does he want to sell you?
Exactly.
Whereas at Artorius, we set the business up to get rid of those conflicts. We have flat fees. So we don't care. We agree a fee rate with the client, and then whether the client wants to be...
So whether it's hedge funds...
Whether he wants to be in hedge funds, real estate,
capital,
bonds, equities, VCTs, EIS, solar farms, whatever it is, we get paid the same. So you get rid of all of that asset allocation bias and decision bias to drive a client always thinking, why am I being told this is the answer? Oh, because it's a big fee.
Yeah.
You don't. You see, set your business up to drive it, then you just get rid of those conflicts.
If I'm looking worried, it's because I'm just realising I get charged more on certain types of products I invest. For instance, structured products.
Yeah.
You know, I get charged more in terms of structured products than I do investing into a tracker fund, XYZ.
Naturally, really good advisors won't drive that. But again, we're all human. And if the person standing in front of you, the bonus on their mortgage gets paid based on the profits you pay that institution, and they have a higher margin product to sell, then again, there's always that conflict of interest. Why have it? Just eradicate it by changing your fee arrangement.
It makes a lot of sense. I mean, I won't. It was weird for me, and it's going to be a story that would repeat with other high net worth individuals, I guess, because, you know, many of us are self-made and we never really came from money. So you there's almost this mystique about, you know, wealth management and what you do. So you hear about these big wealth management companies and you go along, whether it's a private bank or specialist wealth managers. And, you know, the problem that you get is you get them advising. Like, I remember I went to one, I won't name the name, and I said, look, I'm really bearish on the S&P at the moment. Actually, this was about a year ago.
Yeah.
And actually, I had the same about 10 years ago, before the 2008. I was bearish just by accident. Just had a feel about the market, just whatever. And I said, look, I really want you to propose to me shares or financial structures that will perform when the market doesn't perform, right?
Yeah.
And they were like, no, we only go long only. And I'm like, well, I don't want to go long only.
Yeah.
Why am I going to go long only? That's absolutely crazy.
Yeah.
You know, and I find that remarkable that you get some firms out there that literally go, no, we just, you know, only go long only. Well, you're only going to go long only. I'll just go into the S&P tracker fund, you know, and that's it. You know, and I'll have low fees.
Oh, absolutely. And again, it's that ability to be fleet of foot, so you're reacting to your client. Every individual we deal with is different. And they are, well, the common factor is they are invariably very, very wealthy. But they're human beings.
Yeah.
They are a lot of entrepreneurs that we deal with.
We think we know what we're doing.
A lot of city think they know what they're doing. Most entrepreneurs are almost by default control freaks.
Yeah.
So investing third party doesn't help, because an investment that just goes up and down and they got no control of. That's a frightening experience when you've run your business for 20, 30 years and you knew everything that was happening.
Yeah.
And then to hand that money over to a stranger and have no control of it, that's a daunting task. So you have to really understand the psychology of each individual client and what they will and won't cope with, how they want to react, and also what are they trying to achieve. Because you can imagine, for a client who wants to make 3 or 4% a year returns, you're going to have a completely and utterly different return set than somebody who needs to make 10 or 12% a year.
Yeah.
And it's the objective of the client that drives the asset allocation, not that bank's particular model and what it wants to sell.
And it's weird as well, because they get you to fill out this profile, don't they? And let's talk about the profile, because within my private bank, I won't mention who it is, but, you know, I'm, you know, reasonably happy with the service. But I'm actually described as a high risk investor. But actually, I don't think I'm a high risk investor. What they really mean to me is I'm a more of a sophisticated investor, because I'm not just investing in tracker funds or whatever. You know, I have a lot of structured products because I'm not so bullish on the markets, the public markets, and I'm looking at more private markets as well. You know, so it's weird. It's just a different profile, but they describe me as high risk, and I'm like, well, actually, I'm trying to be everything but high risk.
Yeah.
You know.
And the challenge for the industry fixating on risk, whilst it's an incredibly important factor, and we do it, we do risk scoring for clients as well. Everybody does it, and it's right that it's done. But when you end up and that's your final answer, I've done you a score, grading of 1 to 10, and here you are, you're a 5, you're moderate risk, and that's where you end up. If that then drives the answer, you've got that potential mismatch where a client comes in, and most of our clients come in asking for the same thing, as you can imagine. They want low risk, high return. And it's going, well, it doesn't kind of work that way. It goes on a spectrum. So if we can sit down with a client and do the risk, but also have a really, really detailed understanding of the objective and the requirement for return, and this isn't necessarily the return that you want, it's the return that you need.
Yeah.
And you run that modeling. It's not rocket science. I mean, you've got 4 factors for every individual, effectively. Number 1, what we describe as the gas bill. What do you physically live on? And that could be 2,000 net a month. It could be 200,000 net a month. Every client's different. What do you live on? What's your lifestyle? What do you need to fund? Your second factor is inflation. Yeah. I know, assuming you want, most clients have got longevity and got long lives ahead of them now after selling a business to live on the assets and want to pass it to the next generation. So you're going to need to keep pace with inflation. For most wealthy people, RPI and CPI isn't a good guide as to what your inflation bucket is, because you need to talk about your foreign holidays and your private school fees and other different things which are different. There is an index called the cost of living extremely well. index.
Is it?
Has to be an American index, isn't it? Done by Forbes, but it's got about 35, 40 years worth of data now, and it does run at around about double CPI.
Yeah.
So wealthier inflation is higher.
Yeah.
So you need to factor that in. Costs, which we've mentioned briefly, but someone's going to be charging you. So what's it going to cost me for all of this? You add those three up, that's your net return requirement. And then you have to gross it up by your fourth and final cost, which is the delightful tax.
Yeah.
So you're paying some tax along the way, and you have to have that gross return. So you can imagine when you do that quick calculation per individual, it might be back of the envelope, but if that answer comes in at 3% or 8%, that really makes a fundamental difference. Then you match that to the risk questionnaire conversation. Well, now do these meet? So if clients come in and say, well, actually, I'm naturally a very low risk taker, but I need 9% a year.
Yeah.
Well, that just doesn't work.
Does not match.
That's not going to match. Something has to give. Then you have to have that grown-up conversation about, well, now what does give? Do I reduce my objectives or do I actually accept higher risk? So it's an iterative process, but risk is just one of the factors. And it's about really understanding. And then you design the asset allocation around the individual.
Because one of the interesting things for those entrepreneurs or people out there that have come into money, actually, it's sometimes it's the worst thing to come into a lot of money. It's actually a question that sometimes when I'm investing in an entrepreneur, I ask them, why are you in business? What are you trying to do? Okay, because what people, they all see the holy grail, don't they? They all go, oh, that guy got 100 million for his business. Isn't that incredible? Actually, it's a bit of a burden, okay? Because let's just use the figure 10 million, okay? Because it's a convenient number. You make a net 10 million from the sale of your business. The first thing that you should be doing is going, all right, I've got 10 million. What do I need to get back every year for the rest of my life, which is inflation indexed, to make sure that I've got enough money coming in the door? What you're looking for is to make that money work, okay? And have a realistic figure. So if somebody had a 10 million amount to invest, I would say, look, 5% is about a benchmark. Okay, I don't know what you think. And you're going to get 500,000 coming in every year. And that's a pretty decent chunk. You know, you're not talking about, mega yachts or whatever, but it's a decent lifestyle to have for you, your family. But you need to set that down. But it then begs the question, well, if all you needed was £500,000 income, you might be better not selling your company, because actually you might take out £500,000 in that private company that you got every year, and you wouldn't have had to pay the tax and the sale X, Y, Z. So it's weird. I think that people don't understand. They all think it's about making that pot of gold, but actually the hard work starts then, because then you've got to go, I need to create an income. Because the worst thing that can happen is suddenly that £10 million, you buy a nice new house, you're suddenly left with 5 million, and you're making 5% on that. Well, that's $250,000, and actually you're spending more than $250,000. So it's dwindling. It's dwindling by $250,000 every year.
Absolutely.
And suddenly you're going to run out of money.
Well, we have those conversations with a lot, especially entrepreneurs. It's more difficult. That you really should be having those thoughts and those conversations prior to disposal, not after. So, because even the conversation about, well, I've done those calculations, is 10 million enough? So somebody comes along with a check and says, I want to buy your business for 10. You say, great, that's a load of money. I'm
and
retired.
That's after tax.
Then you do the calculation and think, oh, actually, it doesn't work.
Yeah.
Too late now. You need to be, again, if you do that back of the envelope calculation, you can say, well, actually, no, I need 12, I need 13. That's what good looks like for me. And as you say,
because you need to make a net 10 to give you $500,000 a year. Say.
Exactly, because then if you're going off and spending that $500,000, say 5% might not sound that big challenge, but you've got no inflation growth left in the portfolio. And if that 500,000 doesn't move and the capital value doesn't, you're now going to rely on this for 20, 30, 40 years. Your lifestyle is going to be nothing like £500,000 in 20 years' time. So you have to have that inflation built in, as well as then the net take and the fees and the tax. So even spending circa 2% a year, you're probably, when you're on the numbers, going to be up to a sort of anywhere from 6 to 8% gross return to be able to spend 2%. And that starts to really drive the numbers. And to say what you really want, or what we would argue, is that You need somebody having these open conversations with you who's driving the end results based on your objectives.
Before you sell
not
the
trying to
company.
sell you a product.
Yeah.
It's like, well, we'll build an objective-based solution here for you, and that drives now how we go and then do the solution. Not because I'm going back on the shelf and sell you a product.
And for those viewers out there, the 2 bits of advice that I would personally give if I wish I was listening to a podcast like this before I sold my company, I'd give 2 bits of major advice is, firstly, understand what you really want to do when you're in a business. There's only 3 main reasons for running a business. There's going to be, I'm in business for my ego, which is just to say, I run this business. And believe me, I'd say 50% of certainly young entrepreneurs are ego driven. Sure. Okay. Then you're next in business to sell a business. That's a very good reason. And certainly myself as a VC investor, that's what I want to back. But the third reason is equally a good reason. You're in business for the benefit of your family and to hand that business over to future generations or to your company or for a future trust or whatever. And that's just as good. Because say you've got a business that's turning over 10 million quid and maybe making, a couple of million quid, you might be taking 500,000 out of that business every year. Well, you know what? You're going to have to sell that business for £10 million after tax to get the same income. And they don't ask that question. So I'd advise people to do 2 things. Speak to someone like you before selling your business to understand what that figure is and what you're going to do, right? And speak to a good corporate finance advisor that's not incentivized just to sell your business to say, is this the right structure for you?
Yeah.
Have you talked with your extended family? Is there anyone else that wants to hand on the business? Is there someone within the team that you want to hand it over to? But those conversations don't happen. I would say with 90% of entrepreneurs, they leave it too late and they've sold the business and they go, oh, what do I do now?
Yeah. And especially what you mentioned in terms of the conversation with the extended family, that's the biggest challenge. And you say it can be a burden, and especially with the children. I mean, how do they stay as incentivized and motivated as perhaps the entrepreneur was when they set up the business? How do you drive their careers and the balance of life? What are your plans around succession planning? What's the voting rights amongst the family? How much communication? We have all extremes. We have, obviously, you can imagine we have lots of examples of too much too soon, which is very difficult to roll back from a children's perspective. We have the other extreme where the kids know nothing about the money and they're almost like lottery winners at some point when that generation dies and the kids have got no idea of what wealth was and don't know how to manage it or have been told or educated how to deal with money. So you need, like most things in life, some sort of balance, but you really need to communicate and think through how do you manage that wealth to the next generation.
And sometimes consider, actually, my children aren't the best people to run this business. I've got some great internal staff that I can give some shares to. And as long as my family get the benefit of the profitability of the business, then that might be the best thing to do, know? Not to just think about, just hand it on to my family, because in many occasions, that's not the best thing to do. Yeah. Let's move on to what I want to specifically ask you today, which is because, we work with each other in terms of private capital. And when I went lucky enough to go to London Business School, and I did a whole course on the private capital markets. And one of the things that stood out was over the past 20 or certainly 10 years, private capital markets has outperformed public markets, I think, by 100%. I think it's roughly that. Okay.
Quite material, yeah.
Yeah. So just for our viewers, tell us the difference between private capital markets and public markets, okay? And why potentially a high net worth individual or family office should consider investing in private capital markets.
Okay, well, the major difference, I mean, that there are multiple differences, but one of the major differences is liquidity.
Yeah.
So your public markets, people will be used to the fact M&S, BP, Shell, Glaxo, whatever shares you're going to buy, you can trade them in a day. Yeah. Buy and sell them, you can look on your iPhone, you can see the price, it's liquid, it's transparent. Private markets are very, very different. I know you might be locked in for a year, you might be locked in for 10 years. There might be no liquidity whatsoever in your shares.
Because traditionally that's private companies, isn't it?
That's private companies that you
not
buy.
publicly traded
Not
shares.
traded, not listed. The price is whatever the price is in between buy and sell it, if you can find a buyer for your shares. So they are far trickier investments to run. Why do people do it? Well, predominantly because, like a lot of things in life, you get paid for giving something up. So if you give up that liquidity, if you're prepared to lock up some money, there is what the industry would call an illiquidity premium.
Yeah.
You get paid for tying your money up. That's quite common sense and logical. You imagine if you went to a fund manager, said, I want to give you some money, but I might need it back tomorrow. And there are liquid versions of private sort of markets out there. That manager has to keep a mountain of cash back. He has to invest in various different things just in case a lot of investors phone him up and say, I need my money back. If you give it to a fund manager and say, actually, I'll come back in 5 and 10 years' time, tell me what you've done, he or she might be able to do completely different things with your money and normally can generate higher returns on that capital. What you then tend to find is with private clients and liquidity, private clients tend to be much more liquid than potentially they need to be. And that is often driven by psychology because we as individuals, understandably, fixate on our own lifespan. So if I speak to for example, like 60-year-old and say, I've got a 10-year lockup in a private equity fund, which is great for you, is it, Kevin, I'm 60. I'm not investing for 10 years. Are you mad? Yeah, but you're worth 50, 60 million quid.
Yeah,
you're not spending it all. And this is money for the kids and the grandkids.
Yeah.
So you now should be thinking longer term. And if you now think, well, what do Yale and Harvard, what does the Wellcome Trust do with its money? What do endowments and sovereign wealth funds do?
They invest it in long-term funds.
They have quite a lot of money. Someone like the Wellcome Trust, an example, will have almost as much now in private markets, if not slightly more, than it does in public markets. They invest significantly in that space because they don't think about death events because of an institution. They don't have a life expectancy. And for multi-generational levels of wealth, people who've got levels of wealth that are not going to spend it all and they're passing it on, they can now afford to have some illiquidity in the mix. Not all. You'd always have some liquidity around to meet cash flow and other different requirements. But whether that's 10%, 20%, 30%, you'll have an allocation into those markets to make high returns. Going back to the earlier point, when you're looking at a target rate of return for an individual, if that individual wants 3 or 4%, you think, well, actually, why bother? You can probably get that in public markets with the liquidity and don't bother.
Yeah, you can
But
get
for
that
most
in bond
clients, you
market.
might want 7, 8, 9, 10% returns. You now probably need to build in a mix of illiquidity in there to push out some of those return requirements. And that's when you wander into this market, which sounds relatively easy, but is easy to become unstuck as well.
Totally.
It's not transparent. It's very difficult to trade. You've got high lockups. You've got a lot of conflicts of interest within there. And you're dealing with a very different animal than a listed market. And the biggest thing for most investors probably to get their heads around, in those private markets, you are most times a very small shareholder. You will normally have a small minority interest in that company, unless you're writing very, very sizable checks. And if you're minority interest, that's very difficult to control.
Yeah.
If the business isn't going the way you want it to, if it's doing different things, a different strategy is changing, whatever, if you own 1 or 2% of that company, that is very, very difficult to control.
Unless you invest in a fund which effectively has a spread of investments.
Exactly.
And that's why they effectively, they do that.
Well, either a spread of investments or a spread of investors. So if you've got a fund or a construct that brings 5, 10, 15, 20 people together, and they as a group are investing, maybe only 1 or 2% each, but now as a group have a 25, 30% stake in the company, you've now got much more power. Not ultimate power, but you've got a real strong interest now, maybe a board seat, maybe some influence, maybe some ability to get KPIs and management information out of the company and stay much more in control of it.
It's weird that you say that, because I think one of the best things I did was I joined an angel investment network. And I think it's a really good way of getting a good broad understanding of making private investments alongside other investors, and it teaches you some quite good disciplines,
Yes.
And I don't think people look at it. Do you think that sometimes the liquidity issue is overstated? Because if we just go back to what we said previously, you know, they would say that I'm being high risk by investing in effectively a less liquid asset. Let's just say the horizon typically might be up to 10 years. You know, you might be stuck in for 10 years, or even though there are secondary markets, but that's more sophisticated. But the reality is, if you're a high net worth individual, you need a balance of liquid and illiquid assets, because it goes back to what is your overall return. If you have everything in liquid assets, you might not be reaching the return parameters. And what, in my experience, what you've got to have is you've got to have a balance between the two. You've got to have enough liquid assets, but also not reject the idea of having illiquid asset or less liquid asset, shall we say?
Yeah, I mean, there are certainly some of our client base, regardless of wealth, who wouldn't touch illiquid assets, and we would never advise them to. They haven't got either the experience or the sophistication or the knowledge or the appetite to do that. But where it is appropriate, there are a significant portion who would, and it is right for, as you say, it is about a mix and a balance there, that they got the right percentage in that liquidity. And private clients no different than a company. Cash is king. Yeah. So you really got to make sure you've understood your cash flows and what needs coming in, what's going out the door, what you might need as an emergency funds. We will often set up liquidity lines against listed portfolios in case of need. So client has a lot of flexibility.
So what do you mean, like Lombard lending?
Lombard loans is so-called. So yes, if you put 10 million as an example, but the bank might say, I'll lend you 6 or 7 against it. Now, you wouldn't draw on that by default, but if again a client says, well, actually, either I've seen a company to buy that and I want to move quickly because I've got a good price on it and I need 2 million in 5 days, you can draw on it, and then you've got cash flow coming in to quickly repay. It gives a lot of flex in the mix to deal with it, but again, not right for everybody.
This is interesting. Okay, this is another thing you're gonna maybe learn today, and it's something. It completely reinforces the idea of money comes to money. Okay, so let's just take the period of 2010 to 2020, largely a bull market. Okay,
largely.
And low interest rates, very low interest rates.
Yeah.
I mean, talk about the opportunity to make money. What was actually happening for many high net worth individuals and sophisticated investors is they would have, say they had 10 million pounds of net assets. They put the entire 10 million into the public markets, made, say, a 5% net return on that, 10% whatever, okay, net return on it. But in terms of what they needed in terms of their liquid assets, they wouldn't sell. They would just have a tracker fund and grow with it. And they would turn around to the private bank and go, oh, I've got a £10 million portfolio. Can I borrow £5 million against that? And they would borrow at 1 or 2% at that time.
Yeah.
But hold on, your portfolio is performing at 5 to 8% or whatever, 5 to 10. Let's just take that as you've got an instant differential. That was money just making money. You were borrowing so cheaply and your money was making money. It was literally money for nothing. And that's what happened for a 10-year period.
It will. I mean, again, right circumstances for the right clients. I mean, leveraging that type of gearing scenario rather than short-term requirements, it doesn't do anything complicated. That type of gearing, it very simply, it makes a good investment better. It makes a bad investment worse.
Yeah.
So it all depends on then what you deploy that money into and what you're going to do with it. And it can unwind pretty rapidly. The market turns on you, margin calls, other various different things. So it needs to be treated very carefully, and it needs to be done in the right way and with lots of buffers and lots of requirements. For the right people, yes, it works. It's like all things, it's not for everybody.
During that period.
Yeah, you can make a good turn on that. Yeah. Again, you have to factor in all the fees and sort of tax and other various different things and make sure you're making a net return. And you have to look at your entire balance sheet. I'll have clients who'll say, well, I know I've got 10 million in a buy-to-let portfolio and I've geared it up by 5 million to do an equity in it. And then you look around and say, well, actually, haven't you got 3 million on deposit with First Direct or somebody? Oh, yeah, but that's different. That's over there. No. When you're gearing up your balance sheet, you need to look at the lowest performing asset you've got. And that's the asset that needs to be beating the cost of finance. And invariably, if you've got cash on your balance sheet, the return after tax will not beat the cost of the borrowing. So if you are going to gear your portfolio and you gear your balance
Look at it as an overall.
you need cash to be virtually nil. And you need to be a client that's comfortable that I can run my cash down, but manage my cash flows within that. What you don't do is have cash and debt on your balance sheet at the same time. Tactically,
Doesn't
you can
make
do
any
it
sense.
short term, but long term you wouldn't. And again, we see it all the time because the clients have done buckets. We've got a pocket over here and a pocket over there, and they keep them separate. No, we've got to look at your entire balance sheet and then make sure it all works.
And you've got to look at the general environment. I would say that the environment now is very, very different than that sort of bull period.
And if you're borrowing that money to invest in capital markets, private capital markets, again, that is a different beast to invest into. The one thing that we always stress, and we'll perhaps come on to in terms of things like venture capital trusts and EIS and things, they are part of that private capital markets conversation, but they're a small part to the extent of that is UK venture.
Yeah.
That's great. And there are lots of reasons why we do that. But you've also got lots of other forms of private equity. I know there's middle market, there's buyout, there's secondaries, there's special sits. There's lots of different types of private equity. And it's not just UK. So where's your Asian exposure? Where's your continental Europe? Where's your America especially, which are big beast for private equity? So you have to be looking at all those markets. And then you've got infrastructure to take account of. You've got potentially some real estate. You've got some private credit these days. So you then look at your UK venture proportion of your alternatives portfolio. It would, on a weighting basis, be relatively small.
Yeah.
There are reasons why clients oversize it. One, they know about the UK and they understand the UK. There's a little bit of emotional attachment. So a lot of entrepreneurs like the concept that they are reinvesting back into you or the UK entrepreneurs in UK businesses.
There's the income tax.
And the tax benefits significantly reduce the downside potential, so that there is an asymmetry to the sort of risk-return dynamic. And investing back in UK entrepreneurs, the patient capital review that the UK government did a few years back now, again, clients would say, well, is it moral to be taking all these tax advantages, which are basically for wealthy people to reduce the taxes? We say, well, in reality, the government has done the analysis and says that actually, yes, there are tax reliefs, typically 30% on EIS and VCT, but those are far outweighed by the tax revenues that are generated from all those companies that are set up with that capital, the income tax that's paid, the ultimate sale on the business, etc. Far more taxes are made from the companies set up than are paid in the tax relief.
As somebody that makes EIS investments, the government be absolutely crazy to remove that tax break, because you would have an implosion of SMEs in the UK.
Yeah.
And SMEs are the driving blood of the financial sectors. They're the ones that later on become the public market. So it'd be crazy. Let's just, before we move on to EIS and VCT, which I do want to get into, let's talk about performance roughly. So let's talk about the performance of the UK FTSE over the past 10 years versus UK private capital, roughly. Give me some rough figures in terms of the returns that you're looking at, comparing one to the other.
Very difficult to do in terms of the type of private market that you're looking at, because again, that comparable index doesn't really exist. You can look at various different sets of data for whether it's private equity funds, whether it is EIS funds like the likes of MMC, Parkwalk, Molten, etc. Look at IRR analysis of those. When you move into the UK venture space, again, it is very difficult to get a peer group sort of benchmark. VCTs, you can look at some of the data that is generated at the generalist level about all VCTs added together. So you do get some data come through, but there is far more dispersion between good and bad managers. So what you'll find is a good manager will deliver a good IRR and a good multiple on your capital, but some will go wrong.
And you're also dealing with more volatile businesses.
You're dealing with more volatile businesses.
Private companies.
Yeah, and what you've seen of late, I mean, again, Roger, I'm sure you've seen it in company valuations. So if you look back, you said, again, a relatively bullish market last few years. And obviously, we had a big negative market in 2022. And in 2022, markets suffered. Equities suffered and bonds suffered. For once, clients have been hit on both sides of the risk dynamic in the portfolios. But those equity side specifically and some of the bond components then did very, very well from 2023-24. So a lot of volatility obviously this year to date. But they rebounded strongly. The smaller cap and the venture space hasn't. So you look in the UK, for example, at the AIM market, it is still down significantly from the 2022 level start of. So that smaller cap market hasn't rebounded. And that has stayed down for quite some time. When you look at VCTs and other things in that space, again, those markets have dropped quite significantly. So you've seen that volatility and the bounce back hasn't happened. That's mainly with interest rates moving and the way that smaller cap is valued.
The figures that I've seen at London Business School was roughly over the past 10 years that the private capital market in its entirety has outperformed the UK public market, UK to UK, by double.
You would, that doesn't sound out of kilter with the analysis that we do. So it depends by asset class, but you can be looking at a premium for the alternative illiquid sector of anywhere from sort of 3 to 6% per annum extra for the illiquid version compared to the liquid version, which over time compounds and builds up to a very significant differential in return. But as I say, it is spotty and it depends on the asset class, and you really have to drive through the detail of it. Because if you look at the alternatives of private equity, if you look at private equity funds, again, when you look at those dynamics within there, that is much, much later stage private companies than EIS and VCTs, which is startups and venture companies and companies that might not be making a profit. Private equity is typically buying things that might be 50, 60, 70 years old, might be highly profitable and have like no big scale, just not listed. So they can go in a completely different direction.
So just to give the viewers a rough understanding of the ecosystem. So what you get is you might get pre-seed investors, seed investors, usually angel investors investing in EIS and SEIS. Then you might have venture capital firms like myself that might come in investing at sort of seed up to Series A. Okay. So effectively, we're investing in venture firms, usually pre-profit. Okay. In our case, 1 to 10 million valuations and making revenues of up to $1 million, really. Where private equity come in is usually we sell on to trade buyers or private equity, and private equity are coming in post-profit, usually in a multiplier of profit. So usually you're talking about valuations of greater, not usually anything below 10 million valuations, but certainly 10 and above. And then you're getting companies that have come out of private equity that are going to either do trade sales or they're going to the public markets, and usually they're much bigger listings. So there's a whole ecosystem that exists there. Let's talk about our little bit of the ecosystems. And one of the things that Artorius does that other wealth managers, and this isn't some sort of, advertisement for Artorius, it's just, I know this is what you do that's different from other people, is that you do invest your clients' money into the private capital markets. And specifically, you invest into VCTs and EIS. So let's give the viewers a bit of background on VCT and EIS investments and what Artorius does.
Okay, so again, as I mentioned earlier, they aren't for everybody. So not all of our clients have them. It is for the right client in the right dynamic, risk mapped, return requirements, etc., and attitude and knowledge and sophistication within them. VCTs and EIS are two very different beasts. They are grouped together because they are similar in a lot of ways in terms of they are venture, they're early stage. They have similar tax breaks up front, 30% income tax relief.
Free of capital gains.
Free of capital gains, which is very attractive. Some tax differentials within them as well.
The level of investment. I think
level
it's up
investment,
to 200,000
200,000
VCT per annum.
200,000 per person into a VCT per annum. Significantly higher, 1 to 2 million for knowledge intensive EIS investments. So you can do significantly more. Venture capital trusts are, we would argue, probably more transparent as opposed to a blind investment with an EIS. EIS, you're investing in, and obviously you're taking upon what it's going to do in the future. If you go to an EIS manager, then you're looking at giving him money and thinking, well, what's his normal process? But I don't know what he or she will buy with my money. Yeah. So it's a blind investment, as it were.
And it's tradable.
The VCT, well,
VCT is tradable.
It is tradable. The secondary market isn't great in them in a discount. So again, you would normally look to hold it for, we would hold it for a 5-year term. But you can see what the venture capital trust may be owning stakes in companies that it's owned for 7, 8, 9, 10, 15 years. Yeah. So you can look at the prospectus, you can look at the actual documents for the VCT and say, well, I know what I'm buying. Yeah. I can see the 10 or 15 companies it owns. I can see the income that it's being produced and the profits and what's being spread out. So actually I can analyse it and I know what I'm buying. Yeah. That's a very different thing. So from a risk perspective, typically your kind of 3 buckets, we would go VCTs first, as a relative lower risk.
Use up your 200,000.
Use up your 200,000 pound. You can see what you're buying. They are existing investments rather than new. Yeah. You have a strong typical dividend stream. Most pay out 5% per annum. And as you say, they are listed, so you can see the price and you can trade them. We would typically trade.
You have to stay in for 3 years, don't you?
5 years for the tax not to be reclaimed. So what we typically do is we would rotate in through a group of 5 to 6 different managers per client, rotating each year. Then in the 6th year, when you go to do another 200,000, you sell your first one, take that 200,000, roll it into the 6th one. Yeah. So now you go from 30% tax relief to effectively 60% tax relief on the same pound. Yeah. And then you roll it again 5 years later. So you're rolling through the VCT into a pool, relatively small pool of managers that you trust and you rate. So that's a rolling program. You can do that strategically inside VCTs. EIS are then a step up in risk, we believe, from an EIS.
Before we get into EIS, I was blown away by one stat, which was the after-tax return of a VCT versus investing in public markets, or the pre-tax return, okay? Can you remind us the one that you described in Manchester?
I think that were those EIS numbers we were working through in terms of the differential in return. Yeah. Because the EIS tax relief is slightly different.
I thought it was on the VCT.
The number I think you're talking about was on the EIS analysis. On VCTs, what we do is try and look at the downside risk analysis that most of the managers that we deal with over the last circa 10 years have produced around between 6 to 8% per annum at the fund level, ignoring the tax relief. Yeah. So when you run that modelling, your pound shouldn't be just a pound in 5 years' time when you sell it. It should have gone up in value. Yeah.
So that's on average a 2 times return, isn't it?
But you can run the numbers on a VCT and actually you still make good money if the manager does nothing.
On a zero.
Manager makes nothing, just doesn't lose you. So significantly underperforms what they have done historically and what the average have done. Say, not guaranteed by any means that they will still give you a positive return. But if they give you nil, the tax breaks alone will still give you a strong return. Yeah. And if they make 2.5% to 5%, again, you'd have to make very, very big returns on a non-tax relievable investment to match the VCT return. So they are strong. The numbers we run on EIS, given probably been through when we were in Manchester, is that analysis that when you look at your pound into an EIS, it's cost you 70p.
Yeah, after tax.
After income tax relief. Now, your downside risk is then that if my 70p disappears, because this investment goes bust, for the right clients, and again, you'd have to go through the tax advisors, you can then apply that 70p loss against your income tax. So if, assuming you're a 45% taxpayer, it's now effectively cost you 38p. So the ones that go wrong, you cost you 38p in the pound, and the ones that go up, you get all of the returns and tax-free. So when you run the multiple numbers, because it's tax-free on the return on the upside, against a manager investing in that same space with no tax relief, so a venture manager who's not EIS or VCT, that manager would have to get you typically around about 4 to 5 times your money compared to a 2x on a VCT or EIS manager to get you the same net return. Now, if you think, well, I've got some of the VCT and EIS managers are quite good, they might get me 2x.
Yeah.
A good manager might get me 2.2, 2.3, 2.4x.
Yeah.
Are they really going to get me 4 to 5x to compensate for that lack of tax relief? That's a big ask outside of private markets.
So when I looked at that, I think broadly it was an average performing EIS or VCT fund, which basically have very similar tax advantages. If it was a really average performing one, would perform at 2 times, maybe over a 5-year cycle.
Yeah.
Okay. We're typically holding it on for more than 5 years. But anyway, let's just say a 5-year cycle. And if it was performing at 2 times, for you to invest in the public market to get the same after tax return, your fund manager would have to get a 5 times return to create the same equivalent after tax position.
Yes.
That's an enormous difference. And actually, when you run those numbers through, I think a 2 times return on a EIS investment is about 9% per annum over a 10-year period. Okay.
10-year.
Yeah. And it's about 13% at a 3 times return. And it's somewhere in between is what your average return's going to be. That's a hell of a return. That's a lot greater than what you're going to ever get in the public markets. And that's one of the most convincing arguments to have a part of your portfolio going into VCTs and to EIS. Let's now talk about your selections, okay? Yeah. How do you select your VCT and EIS funds that you invest in?
Okay, so a lot of the VCT ones, we have a panel. So we look through a range of different criteria for VCT manager, a lot on track record, but also transparency.
Give me your top 3.
Manager.
Come on. Give me 3 names that you like in VCT.
Look, there are strong performers out there. So if you look at the likes of Mobius, if you look at the likes of British smaller companies or Northern, really strong managers. There are others in our panel as well. That's just 3 examples.
Okay.
But those are 3 highly rated, good quality teams, transparent on fees and structure, and have delivered strong returns for the clients. Yeah. So those are the sort of managers we would look for. Say, rather than top 3, we'd typically build out a portfolio with 6 to 7 managers in the VCT space for clients and be rotating those through that group every 5 years.
And EIS?
So EIS, again, we have that 2-strata approach that for clients can either go direct and choose their own EIS.
Yeah.
But there's a lot we've talked about in terms of skills and requirement and knowledge and time to get involved in that space. Or you can use an EIS manager.
Yeah.
Now a manager
has got a portfolio of investments.
So you make a commitment, you say, right, I'll do £100,000, and they will say, right, we'll spread that across 6 or 7 different investments. So they'll do 20, 30 grand across
Or some EIS managers like ourselves do deal by deal.
Deal by deal.
Yeah.
So
we go out and find a company for you. We do the due diligence.
Yeah.
You know the sector is in, and we focus on managing that investment for you.
Absolutely. So we would always, and we do from Artorius, we like a lead investor. We like somebody who's driving that deal, who knows the space, knows the sector, has got the skills and can drive the negotiations on valuation, preference shares, all the other discussions, board seats, etc.
And especially if you have a general partner from the firm that invests his own money.
Absolutely. So you want skin in the game.
In my case, I do.
Yeah, you want skin in the game and somebody sort of
That's an unashamed plug, by the way, for us.
Indeed.
Look, I've been plugging Artorius, so.
I mean, if you go direct, and some clients will go direct and say, I've come across somebody and I've found out about an EIS I want to invest in.
And they can't resist that, can they?
They can't resist.
Because a lot of your guys are self-made entrepreneurs.
They are self-made entrepreneurs. Most, not all, but most 3 to 5 years later, and we'll come back and be brutally honest, say that was a pain in the arse. I'm not going to do that again. Because you get the phone call on the Thursday saying we're running out of money next Tuesday. Can we have another 50 grand, 100 grand, please? And so you invariably then saying, well, your first check's not your last check. So you'll have to keep writing and funding this business within the structure.
Or cut your losses.
Or cut your losses and walk away. We're saying to clients typically, do that on either one of 2 metrics. If you go direct, either one, a management team that you physically know, So you know these people, either they worked in your business or you know them personally and you trust them, or it's a sector that you know well. So you've made money in that sector. It's where your business was and you understand it, and you can do the detailed due diligence.
Do you mind me saying, right, I'm going to be brutally honest with you. Look, you said it before, many sort of high net worth individuals, entrepreneurs, successful entrepreneurs, our ego is a bit out of control and we don't take advice very well.
Yeah.
And it's the same as somebody that's just made a lot of money, that's never managed money, coming to you and going, well, I'm going to invest it myself. And let me just tell you, I've done that, and that's a mug's game. Because in the end, you might pay someone like Artorius, depending on your funds under management, say 0.5% to 1%, whatever it is. But trust me, it's worth every penny of it because it comes with expertise and you know what actually performs. I would say the same with EIS, okay, which I've made those private investments myself as an angel investor, thinking I know what I can do. But the reality is when you make an EIS investment, you have to do 4 things really well, not one thing.
Yeah.
You've got to raise all the money.
Yes.
So if you're an individual EIS investor, you're only partially funding the business. You're not sure if the rest of the money's coming in. Whereas if you're involved with a fund who's funding the entire funding round, as we do, all of it's been raised. Because if it's not all raised, they don't allocate your money.
Yes.
Then you've got to make sure you're paying a decent valuation.
Yeah.
And let me stress how important that is. You know the market. Is it a buyer's or seller's market at the moment? Okay. And what the actual valuations are, because you've got the data and you get a feel for the market. Certainly if you're a sector specialist, we're a consumer brand fund. So we know what the valuation should be. Then, okay, you might be lucky enough that they did raise all the money. You have paid a decent valuation, but you've got to add value. So in our case, we sit on the boards and we try to add value. And then finally, that's all right, adding value and everything. There's only one thing that matters, getting return, which means selling the company.
Yeah.
So you've got to have an expert selling the company. So look, whether it's us or anyone else, I would strongly advise against anyone doing their own individual EIS investments, because I don't think they've got unless they really want to be hands-on with the business, because I don't think they've got the expertise or the time or necessarily the resources to really manage it. Okay. The same way as wealth management.
Yeah.
You think you're saving money, you're actually losing money.
Yeah.
Go with somebody that's an expert and, obviously have a feel for what you think. If you don't want to, invest across a breadth of investments and you want to invest in a particular thing, you might go to someone that does deal by deal like us, Yeah. If you don't want to touch EIS management or EIS venture firm, you might go, I want to go to VCT. Or you might go, look, forget about VCTs. I want to invest more secure investments like private equity funds. So, it depends your level of appetite. But what I would say is just, it's not as simple as just making that investment.
It's not as simple. And the other thing we touched on it earlier in terms of succession planning and the kids, etc. You have a very, very complex portfolio of these private client companies. Who's going to pick them up?
Yeah.
Something happens to you.
Yeah. Who's going to manage it?
I know, invariably, not always being sexist, in the spouse and the children are then now picking up a portfolio which you've got no idea about.
Yeah.
And then they have to then manage that, or then bring somebody in to try and manage it and exit it over a number of years.
Yeah.
So there are other things onto it. And you mentioned breadth. And I've got a client who's very, very active in this space. And he'll say, quite right, I don't know which are going to be the winners. And he's targeting a portfolio of 250 different positions.
Wow.
Now, the administration about that alone is off the charts in terms of all your tax returns and everything else, and just trying to keep pace with those portfolios. And he takes the view, well, I fund by milestones. So all the ones that meet the milestones, I write another check. The ones that don't, I just write off.
Yeah. Which
so
is like a follow-on. We do the same
approaches.
thing. So we'd say 10% or 20% of our investments we will follow on with.
Yeah.
We're backing the winners, and that's quite typical. Just wrapping up now, because I know time is short, because one of the interesting perspectives at the moment, it's obviously a very difficult market, okay? Sure. And myself, I'm a big believer in contrarian investment. So I'm really influenced by the guys like John Templeton and Warren Buffett that basically believes in times, I think John Templeton famously said, in the time of maximum pessimism, it's the best time to buy. In the time of maximum optimism, it's the best time to sell.
Sure.
And I think in the UK at the moment, it's the time of maximum pessimism, sort of post-Brexit. It's been difficult in the financial markets, the effect of Trump, XYZ, okay, a new Labour government, whatever. And as a result of it, I think there's incredible valuations out there.
Yeah.
And we're not talking about liquid assets that we're trying to sell tomorrow. We're thinking, what's going to happen in 5 years' time?
Yeah.
I personally think that the outlook for the UK economy in the next 5 to 10 years is reasonably strong, because I think we've really underperformed in the past 5 years, personally, I think largely because of Brexit or, post-COVID, you could maybe argue. So I think it is a great time to potentially invest when the valuations are low in terms of private capital markets and EIS investments, and then holding on to it because, we're buying cheap and hopefully the market's going to bounce back. What's your viewpoint?
It's similar. I think obviously it is about selection. I know that there's still a lot of dross out there and a lot probably will fall by the wayside. We would probably argue, even with the spike in interest rates that we've had, I know it's a long, long time since we've had a good old recession, as you and I would have experienced it, that flushes out a lot of companies. Well, even that wasn't, a recession as we would know it, an economic recession, more a financial recession. So you have to go back a long time before underperforming companies were washed out.
Yeah.
From a valuation perspective, what you can see is that companies have been hit hard, because what's happened is that the growth metrics of 5, 6, 7 years ago, where it was just keep growing, build market share, don't worry about profit, that'll come later. That died in 2022. So that died away, and everyone scuttled back and said, actually, get that obsession to growth turns to an obsession with profit.
Yeah.
Right, cut your costs, big headcount reduction, pull everything back, get yourself profitable. Those companies then found that the ones that survived spent 12, 18, 24 months turning themselves into profit. They've done really well. And then everyone turns around and then says, well, actually, from a valuation perspective, rather than the growth valuation, we'll now give you an EBITDA valuation. Well, actually, I'm only making 50, 100 grand because I'm just moving into profit. Yeah. So a multiple on that's a very small number. So the valuations are being really squeezed in that sector and are still down. So from a valuation perspective, if you can drive the right thing, the challenge you will find is that a lot of companies still hate down rounds. So they still hate to come to the market with a valuation lower than what they previously had. So you really need to understand, am I involved in a down round or aren't I? And what's driving that? You touched on it earlier in terms of point that you enter. So entry,
I love a down round, by the way.
Love a down round, but secondary market can be strong for that as well. Again, picking up second-hand shares because it isn't as transparent as a down round. So again, if you can pick up second-hand shares, you don't get the tax breaks, but again, can be, from a valuation perspective, a good point to enter. And then just choosing where is that company in its cycle. You and I will have experienced a lot of times where clients get in very early into a company. I think I was one of the earliest in. This is great from a valuation and return perspective. 2, 3 years later, the business grows, it does well, it meets its milestones and its targets. Then the VC comes in and then says, well, I'm now going to invest. And says, yeah, great, we've now got a VC on the books, but they want preference shares, they want rights, they want various different things. And suddenly they cram down the original investors and think, well, hold on a minute, I would have had a better deal coming in 3 years later alongside the VC. So back to the point we were touching earlier, going in alongside an institutional, quasi-institutional investor to do that. If you don't, you really, really need to focus on that valuation you've gone in at and don't overpay.
For our viewers that don't know what liquidity preference shares are, you sometimes get VCs who go, we want a 3x liquidity preference shares, okay? And that effectively means is that we want guaranteed 3 times of our money out before the sale, okay, and also our equity money out. So that prejudices all the other investors that haven't got 3x returns. It effectively dilutes them massively, and it's a little
Yeah.
I'm not a massive fan of it. I think it's really
participating prefs, which you just described, we don't see very often now. They were around a little bit, but they really cram down the existing investors. You'll find non-participating where they say, well, I'll have 1 or 2x preference.
Yeah.
So I just get my money back first before anybody else does, and then you all get a share.
Yeah.
Now that again can create conflicts because
guarantee of 2 times my money back,
if they
plus my equity value.
Well, so often they won't get the equity value on top as it tends whether it's participating or non-participating. But effectively, you're in that strata. If they've then got a value of the business, which is the downside, and you get to a point in the growth of the company where the shareholders saying, actually, we need to take some risk with that to move it to the next stage, those preference owners would now turn around and say, well, no, that's our safety net. So we're not taking the risk. So again, you have to manage then the differential.
And then I don't want to go in
the objectives of now 2 different share classes. So it takes a lot of management. And again, a lot of the times it is best to go in that round and at that point, if you get, or you've gone in really early with control at a good valuation and you can control that journey when the bigger checks come in.
The detail.
Always in the detail.
Yeah, exactly. And this is why you need, experienced advisors like yourself. On that note, look, Kevin, I mean, one thing I really want to stress is I've invited Kevin today. I'm actually not a client of Artorius, but, I've looked at Artorius, but I really respect what you're doing in terms of giving independent advice. Okay. I really like the fact that you offer both private capital investments as well as public investments, which many wealth managers do. And I really wanted our viewers today to understand the difference. What's it like to make money? Who should you go and see? And I think today you've really given us some fantastic insight. And honestly, if you're, starting to maybe make some money, I wouldn't hesitate in recommending Kevin and Artorius. So it's been a pleasure having you today.
Been a pleasure.
Thank you.
Thanks, Roger.